My name is Tabby Perkins, and I'm a Business Development Officer for Zions Bank. Welcome to our seminar today, where you will receive an overview of the market and the economy. It is my privilege to organize seminars that educate our valued clients on pressing topics, and it is always my goal to introduce you to professionals that can help you achieve your financial goals. I will be your host today, and we will begin with opening remarks by Scott Anderson, President and CEO of Zions Bank.
Well, thank you, Tabby, and welcome to Zions Bank's quarterly economic and market overview. As Tabby said, I'm Scott Anderson, and I'm President and CEO of Zions Bank. And we are excited to present this update on the current conditions in our nation and in our region. I'm thrilled by the name of today's event. The theme is Navigating the Return of Uncertainty. And I told Robert and Rich that I'm really looking forward to their comments because I do think a lot of us feel uncertain about the future. And just a few months ago, the economy was looking strong, the coronavirus was receding, health precautions were dropping, and businesses were open and expanding. However, as we've seen this fall, COVID continues to provide challenges, and the surge of the Delta variant caused disruption and has reintroduced uncertainty into the markets. So where are we and what will happen in the future? Rich and Robert will let us know. Well, last year we had to contend with a shortage of toilet paper. Today we're facing what has been called a shortage of everything. High consumer demand, fueled by excess liquidity and changing spending habits, has clashed with supply chain disruptions due to COVID restrictions overseas. And in the United States, a shortage of labor has disrupted the supply chain as distribution networks strain to get final goods to the consumers. And we're told by the TV commentators that we should go out and buy what we want now for Christmas because it may not be here when we normally go to shop. And this has caused price increases and inflation surge to the highest levels in the past 20 years. And while some people thought this dynamic and still think this dynamic would be temporary, it appears to me at least to be more persistent and that we could face these struggles into 2022. However, I would add that the underlying economy looks strong and consumers remain fairly confident, and the regional economies of Utah and Idaho are robust, and they lead the nation in job growth and economic vitality. So today we'll hear from Zions Senior Economist and from Zions Wealth and Fiduciary Services Senior Portfolio Manager. These experts will talk about how the markets are looking to date and give us their predictions for the future. So I'll turn the time now back to Tabby for a more formal introduction of Robert and Rich. And again, I thank you for being with us, and I hope you enjoy it, and I hope you benefit from the information that's presented. Thank you. Tabby.
Thank you, Scott. We are so lucky to have you as a leader during these trying times. Okay, as kind of a little bit of information, at the end of the presentation today, we will have a Q&A session. We had so many excellent questions submitted from many of you when you registered for the seminar. A lot of them revolved around housing, inflation, and interest rates, which we will be addressing throughout the seminar. However, we've selected a couple of the best questions that we really liked that we will address at the end, time permitting. For those of you that do have questions throughout the presentation, keep them in mind, and we will send you a link at the end that you can submit a lot of those that will go back to you on your personalized questions. Our first presenter is Robert Spendlove. Robert is an economic and public policy officer at Zions Bank, where he monitors and reports on economic indicators and public policy developments. He is known for his insightful and understandable approach to explaining economics. I will now turn the time over to Robert.
Thanks so much, Tabby. It's great to be with you today, and it's such an interesting time. Just like you said. Oh, hold on. Let me see if I can get this one up real quick. There's so many interesting things going on right now in the economy, in markets. It's truly such a unique time. Okay, and Tabby, can you see that?
Yes, I can. It looks good, and your volume is great.
Okay, great. Thank you. So I just want to quickly go through some of the really interesting trends that we're observing right now in the economy. So if we start off looking at the labor market, so the first Friday of every month, the Labor Department releases their monthly jobs report, and for several months, you can really see, ever since the beginning of the year, we saw really strong recovery and job growth going on in the economy, kind of maxing out in July with over 1 million jobs added to the national economy. However, you're going to see this a lot. This as the Delta variant started to surge, we started to see those numbers drop. So in August, we had a depressing number, or lower than we were anticipating. And then again in September, more slowing, dropping down to 194,000 jobs added. So we really should be adding about 1 million jobs a month right now. When we look at where the jobs have changed, so this is looking back to February of last year, so kind of pre-pandemic, until last month. And you see that every major industry still has fewer jobs than it did before the pandemic. But also the really big impacts being felt by leisure and hospitality, which is still down 1.5 million jobs. Also education and healthcare, down 900,000 jobs, and government down 851,000 jobs. The unemployment rate is another interesting example of what we see happening right now. This is, it's really interesting to compare what's happening this cycle to last cycle. So the shaded area on the left is the Great Recession. And what you see is that unemployment rate went from right around 4.5%, 5%, all the way up to 10% after the Great Recession. And then it took almost a decade for that to come back down to that low level again. Going into the pandemic last year, in February of 2020, we're at 3.5%, jumps all the way up to 14.7%, the highest unemployment that we've seen since the Great Depression. But then it has been quickly coming down. Now, if you were just looking at this chart, you'd say, okay, we're back to where we need to be. Our goal is this full employment. 4.5% to 5% unemployment rate is the level where generally employees can find jobs and employers can find workers. So that's kind of the sweet spot. Well, we're there. We're at 4.8%. And now we're not where we were pre-pandemic, but in normal times, an unemployment rate of around 4.8% would be right where we want to be. So here's the problem. Right now, we have more than 10 million job openings in America. So our labor force is 5 million lower than it was pre-pandemic, but we have 10 million job openings. So there's a disconnect going on. We've got all these job openings. We've got many fewer people working than pre-pandemic, but we're not getting those people into these jobs. And that's creating this strain and is creating this labor market shortage that we're experiencing so much. And that's why any single indicator like the unemployment rate can't really show what's happening and the struggles that we're facing right now in the economy. Another indication of this is the quit rate. So on the left is the quit rate as reported by the Bureau of Labor Statistics. It's now at 2.9%, the highest that we've ever seen of people voluntarily quitting their jobs. And then on the right is a little bit of information about the nature of the industries where people are quitting the most. Really interesting. Leisure and hospitality has our highest quit rate of over 6%. And then number two is retail. at almost 5%. So really interesting that these are kind of the areas that have been struggling to kind of recover in the last year and a half. And if you remember back, leisure and hospitality was the area that is struggling the most to even come back to where it was before. And now we're seeing very high quit rates in that industry. And both of those are above the average of all industries. Now, so this is the one that kind of explains it all. This is looking at the labor force participation rate. And what is that? It's the essentially, if you take the entire population of the country, the working age population, so population over 16, and then say, of that group, of that total, how many people are working or looking for a job? That's your labor force participation rate. And our goal is to have that participation rate be as high as possible. Back in the 1950s and 60s, it was around 59%. But then as women came into the workforce in very large numbers, that participation rate topped off around 67%. And think about how strong the economy was in these periods during these decades. We saw increasing quality of life, increasing productivity, increasing economic health. Now we started to trend down in 2000, where we saw that labor participation rate drop down to about 63%. This dynamic is different. So this is essentially retirement of the baby boomers. So, even as the economy was recovering after the Great Recession about a decade ago, we had the labor participation dropping. So this is not a new trend, but it's something that we've been observing as the older workers have been retiring, and we see this big wave of baby boomers retiring. But the economy was so strong from 2016 to 2020 that we saw a little reversal of that, and it started to go back up again. But then look right over here on the far right, 63.3% in February of 2020. Then the shock hits, 20 million people get laid off, and it drops all the way down to about just over 60% labor participation. So we would expect that it would come back to this former level. So our goal is 63.3. Where are we today? 61.6. So there's our gap right there. There's our 5 million people that have not come back into that don't have jobs and are not in the labor force. And this is the real struggle. This is what's creating that labor shortage. And if you look at that trend, that line, not only is it much lower than it was before, but also it's not coming up. So we don't see that line increasing. So we're not pulling more people off the sidelines and back into the labor market. So if we look at a little bit of detail, who are the groups that are struggling right now? And it is overwhelmingly women and also less educated workers. So on the left, you see both women and men saw their labor participation drop, but women dropped much more dramatically, and then have struggled to come back into the labor force as men have come in greater numbers. And this is the one that really troubles me. So this is just the last month. In the last month, when we have so much demand for labor, the labor participation of men went up and the participation rate of women went down. So we see that those real struggles that women are facing to get back into the labor force. On the right, we see that those workers with at least a bachelor's degree are actually higher today than they were pre-pandemic. But they took a huge hit, and now, similar to women, in the last month, we saw labor participation of those groups, of those people actually go down. And then that other dynamic that I mentioned with the retirees. So this is looking at labor participation by age. And we've broken it down into teenagers, 16 and 19, prime age, which is 25 to 54 years old, and then the 55 and older age group. And you really see this here. So look at the teenagers. So everyone saw that shock, that initial shock, But since then, teenage participation has been trending up very strongly, and today is higher than it was pre-pandemic. So we're actually seeing we are pulling more teenagers off the sidelines and into the labor force. Our prime age, or 25 to 54, looks similar to the top line participation rate. But then look at the older workers, the 65 and over workers, where they saw that initial kind of that shock, a little recovery, but then it's essentially been trending down, even as the economy is expanding, even as we have such a high demand for that labor. Now we have seen a little bit of an uptick just in the last couple months, but this is the big struggle is will we be able to pull these 55 and older workers back into the labor force? And this is kind of an unresolved question. We don't know whether we're going to be able to get the same labor participation that we had before the pandemic, but it's creating this struggle as our economy was used to having 5 million more workers than we have right now. And so it's we're all struggling to deal with that lack of labor in our economy right now. The other result of this is we're seeing wage pressure starting to build. And if we look at our long-term average, we were right around 2.7%, a little bit higher before the Great Recession, and then a little bit lower following that. Now, when the pandemic hit, this is one of the byproducts of the pandemic, is it essentially ruined this data series for about a year. There was no way that people were seeing 9% wage increases, and then which then dropped down to 0.5%. What this was reflecting was the nature of who was being laid off. So primarily lower wage workers were laid off. Of those 22 million people, it was overwhelmingly lower wage, and so essentially the indicator was dragged up artificially, and then the indicator was dragged down artificially as lower wage workers re-entered the labor force in very large numbers. But just in the last few months, this has started to become relevant again, or accurately reflecting what's happening. And we see that wage pressure, or wages, are going up about 4.5% over last year. And that is consistent with what we're seeing in other indicators. But this sounds great, and it's great to see workers getting paid more and people seeing their wages go up. But it's starting to add into that struggle of inflation, which I'll get to in just a minute. Our overall GDP, so this is another one of the kind of surprising ones. So we looked at the labor market. The overall economy is back to where it was pre-recession. And that was a real surprise. Many economists thought it would take several years for the economy to recover from where it was before. But we saw really strong growth late last year and early this year, and GDP has been coming back really strong. Now, we just got a new measure of GDP this morning, and the growth is slowing. The growth for the second quarter was 6%. For the third quarter, dropped all the way down to 2%. So we are seeing that slowing growth in GDP, but overall, it's showing that the economy is fundamentally sound and is fundamentally strong. So that's a good indicator of where we're going right now. Consumer confidence is another one. Consumers are the most important part of the economy. Consumer spending is about 2/3 of the entire gross domestic product. So if consumers feel good, then the economy is going to do well. If consumers are nervous, then the economy is going to suffer. And we really saw that. So here's that. The green line in here indicates where people feel like the economy is prosperous. Going into the pandemic, consumer confidence was above 130. And by the way, this is data from the Conference Board. Took a huge hit when the pandemic hit, dropped all the way down to the mid 80s and kind of stuck around there for most of 2020. But then as we were recovering, as the economy was reopening and people were getting vaccinated, that confidence really shot up, got all the way up to 130. And then once again, that general theme, the Delta variant hit, that consumer confidence starting to drop. Now, the good thing is just in October, we saw an uptick in that confidence, and it's still above that level where people feel like the economy is prosperous. So consumers are less confident than they were 2 years ago, but more confident than they were last year. However, and this kind of, there's two reasons why we are seeing high inflation right now. And one of the reasons is a good reason. And it goes back to, I'm going to actually jump back real quick. It goes back to this because consumers do have a relatively high level of confidence, and consumers are demanding a lot of products. So consumers are buying a lot. And so when you've got high demand, and then that gets coupled with what we're seeing right now, which is low supply, and we're all talking about those breakdowns in the supply chains. The result is inflation, and so this is one of the things the Fed is watching really closely. The Fed has a dual mandate. They're mandated by Congress to focus on two things: full employment and low and stable inflation. Their target is 2%, and going into 2020, we had actually very low inflation, right around 1%, and then the pandemic hits, and and this is just kind of a recent dynamic of this year. We've seen that high demand coupled with low supply really driving up those consumer prices, now at 5.4%. So remember that wage growth is 4.6%, but inflation is consumer inflation is 5.4%. And so you can see how those two are so closely tied, and those wages are kind of chasing inflation, but they're also driving inflation. And this is one of the things we have to be really careful about, because we can turn into a vicious cycle of wages chasing prices, which causes higher prices. And so it's one of the things that we need to be really careful. When we look at some of the areas that are seeing really big increases, a big part of that is meat products, bacon prices. So, we've seen bacon, eggs, beef, and veal all up just under 20%. So big increases there. But then furniture and bedding also hitting big price increases as well. And then other areas like apples, window coverings. So we're really seeing it. It's not just a certain area. It's several different areas that are being impacted by these inflationary pressures. On the producer side, the pressure is even greater. Just a minute ago, I showed you the consumer price index. This is the producer price index, and this is essentially looking at inflation before those goods end up in the store. Producers are seeing 8.6% inflation on an annual basis, and so and there's only so much of these price increases that companies and producers can absorb. They essentially have two choices: either they take it out of their profit margins, or they pass those costs along. And as those profit margins get thinner and thinner, producers have less choice about what they do to respond to inflationary pressures. In addition, we're seeing a number of different areas that are showing that are causing those price changes and those inflationary pressures. So this is just looking at both nationally and more regionally some of the home prices that we're observing right now. Just to put it in context, so 2008 was kind of the peak year for, I'd really say 2006 to 2008 was kind of the peak period for housing prices. And then we always refer to this as kind of the housing bubble, which then burst and dropped down in 2011 and 2012. Well, where are we today? We're way above the levels that we saw in the previous bubble heading into the Great Recession. And not only are we going up, you can really see an inflection point right about here in 2020, where that we kind of saw the nature of housing demand change, and we really saw not only nationally home prices kind of tick up, but look at Idaho and Utah. Idaho, as recently as 2016, the average home price was below the national average. Now it's way above the national average at 436,000. Utah also has, you have to go back a little bit further. You have to go back to 06 before Utah had lower prices in the nation. But now Utah is nearly 200,000 more than the nation in the median home price. And when we look at the housing price appreciation, it's even more dramatic. Again, this is looking at the 1 year growth rate in home prices. The US at 18.4%, Utah at 29%, and Idaho now at 36.5%. And this kind of growth, just frankly, is not sustainable. We can't have 30 and 35% housing growth into the future. My hope is that we'll slow down to something like this, like a 2 to 5% annual appreciation. My fear is that we'll see something like we saw in the Great Recession, where it actually goes negative when we see a drop in housing prices. But it's we don't entirely have a good sense of exactly which way it's going to go at this point. It's also caused, this dynamic is also causing rental prices to go up, which is a recent trend. Generally, home prices will fluctuate much more than rental prices, and rental prices will kind of stick to where they were. And you see that all the way back to 2010, even with the big changes in home prices, we didn't see big changes in rental prices until recently. We've seen those rental prices going up pretty dramatically around the country. Another dynamic is energy prices, where just over the last week, we've seen oil prices above $80 a barrel, whereas recently, as a year ago, they were down around $25 a barrel. So that's, again, just providing that there's all these different pressure points that are causing inflation to go up. And then this one is just an interesting one I found from the Financial Times, looking at the impact of those supply chain breakdowns. So this is, on the left is the price of bringing a shipping container from China to New York. On the right is the price of bringing a shipping container from China to Los Angeles. And you see, pre-pandemic, it was around $1,500 to $2,000. And then as recently as September, New York was over $20,000 and is still just under $15,000. Similar in LA, saw that cost skyrocket to over $15,000. Now they're both coming down very dramatically, but this might remind you of what we saw earlier this year with wood prices. It's just causing this high volatility in these costs, and these are the costs that producers are facing, and then are coming down to the consumer level as well. The Federal Reserve responded essentially to the pandemic because there was so much fear of what the pandemic would do. They responded by dropping their federal funds rate down to 0. So essentially sending the message that interest rates should be low. So the question is what to do now. If you're Jerome Powell, what do you do now? When we're in the most accommodative state that the Fed has. Well, here's one indication. So this is a really nerdy chart, but essentially we call it the dot plot, and each one of these little dots represents a vote of one of the members of the Federal Reserve Federal Open Market Committee, saying where do you think it would be appropriate to have interest rates in the future. And it kind of gives an indication of what the Fed intends or expects to be doing in the future. So they've said for 2021, the Fed funds rate stays at 0. But as soon as 2022, the Fed expects to start raising interest rates and then raise them more in 23, more in 24, and back up to around 2.5% in the long run. The only question now is when the Fed starts raising that Fed funds rate, whether it will be early in 22 or whether it will be like first half of 22 or second half. I see that happening sooner than we anticipate. I think it's going to be a first half rate increase with the Fed. The second part is the Fed's bond buying. So the Fed uses their bond purchases as a way to inject fluidity into the market, essentially to print money. This is what, when you think about the Fed printing money, this is what it is. And the Fed, look over on the right, has responded dramatically to the coronavirus, took their balance sheet from around $4 trillion to now it's over $8 trillion. So they doubled the size of their balance sheet in about 18 months. And what they've been doing is every single month, the Fed is buying $120 billion of securities. Even today, they're still buying $120 billion of securities. And I expect the Fed will start cutting back on this very soon, pretty much any day. They've said it will be somewhere in November. They're going to start tapering off those bond purchases. The Bank of Canada actually just canceled or stopped theirs entirely yesterday, or announced that they're stopping their new bond purchases yesterday. While the Fed is expected to taper off, other major countries are pulling back pretty quickly because of the fear of overheating the economy. Now, turning to our local and regional economies real quick, things are looking really good in the Western region. So this is looking back to February of 2020, so pre-pandemic, to September, which is the latest data we have. There are only 2 states in the country that have added jobs in that period, and they are Utah and Idaho. So Utah and Idaho are really leading the country in that economic recovery, and you can see some of the other states that are still really struggling. Nevada is still down 6.5%, New Mexico down 5.8%, Wyoming 5.7%. Then you jump kind of, New York is down 8.9%, Louisiana down 8.8%, and then the big one, Hawaii, is still down 13%, or their jobs are 13% lower than they were pre-pandemic, just to put that in perspective. Looking in Utah, all industries but natural resources have grown. This is just looking back for the past year, so September 2020 to September 2021, but big growth in that. Leisure and hospitality. So this kind of shows how Utah is kind of bucking the national trend. We're seeing big growth in leisure and hospitality. We're also seeing big growth in manufacturing and also construction. What about Idaho? Idaho also doing really well. The one area where I'm a little nervous about is this manufacturing, dropping down by 1.6%. This is one of our kind of economic drivers. So it's a little troubling to see manufacturing in Idaho dropping by 1.6, but we also see big increase in leisure and hospitality, education, health services, and then that natural resources and mining, and then also financial activities doing really well. When we look at the unemployment rate, similar trend. Utah is the second lowest unemployment rate in the nation with 2.4%. Idaho right behind Utah, 2.9%. And comparing that to the US rate of 4.8, we have extremely low unemployment and very tight labor markets in Utah and Idaho. And then again, higher unemployment in Nevada and California, higher in New York, and also in Hawaii and Alaska. When we look at, so this is a really interesting one. It's looking at that labor force participation rate that we talked about earlier, is that one in the green. Now, I also put in Idaho and Utah, and you see kind of those similar shocks that kind of drop down initially. But what's really interesting is while Idaho continues to see that drop in the labor participation rate, Utah just in the last few months has reversed and is now going up. So there is kind of a difference going on between the Utah and Idaho labor market, where Idaho continues to kind of lose people out of the labor market. Utah's reversed that just recently and is now pulling more people off the sidelines and back into the labor force. And then when we look at the kind of our broad measure of state level GDP, our leader in the country is Nevada, coming in at 9.7%. Now, this is looking at the first quarter to the second quarter of this year on an annualized basis. So much of this is reflecting recent growth and building off a lower base because of the struggles that we had last year. Now, the U.S. growth rate is 6.7. So both Utah and Idaho are seeing a little bit slower growth than that. Colorado is higher than the national average at 7.2. And then Texas is right around that national average, just a little bit below at 6.4%. When we kind of put it all together, the economy is still fundamentally strong. We continue to face these COVID struggles that we've been facing, and it is softening. We saw that with the GDP number this morning. That we are seeing the impacts of the Delta variant, and we are seeing the impact of these the supply chain struggles. But the bottom line to me is that the regional economies are really strong, are leading the nation, and it's because of this growth that we will continue to really flourish around the country and flourish around the world. The one struggle that I see, in addition to our labor shortage, is those housing prices can't continue to go up the way they have been, and they are placing a strain on communities, especially for those younger workers, lower income workers that really are struggling to kind of get that first house or be able to keep their apartment. And so that's something we need to be very serious about addressing and kind of helping out. With that, I'll send it back to Tabby.
Thank you, Robert. As always, that was a lot of really interesting and pertinent information. I find it fascinating with the pricing increases, specifically with meat. It's making it harder to literally bring home the bacon. That's what I was thinking when you posted that. So a lot of really great information. We have some people asking about how they can look back through the slides and whatnot. As an FYI, we will upload this recording to YouTube later today. And also, if you search YouTube, go and subscribe to the Zions Bank channel, and then you can receive notifications every time we upload a video like this. Okay, we are transitioning to the next speaker, so we're going to swap over some slides while I do an introduction. Next, we will hear from Rich Mebius. He's a portfolio manager for Zions Wealth Management. Rich has over 16 years of experience in the financial services industry. He works with high net worth clients, institutions, nonprofits, and other entities implementing investment strategies to meet the client's goals and manage risk. He is a really great asset. So if you have, as he's presenting, thinking through things that maybe you might want to follow up with him after, he is such a great resource. And I will turn the time over to him now.
Great. Thanks a lot, Tabby. Appreciate that. And really good information from Robert. My goal today is I'll just talk about really the third quarter, where we see markets at right now, both on the equity and the fixed income side, what we look for through the end of the year, and tie that up with some of those concerns and some of the things that we've seen on the economic side. So to get started, just looking at third quarter returns, third quarter did see the return of volatility. For those of you that do receive some of our communications, we talked about September being historically one of the most volatile months of the year, and it did not disappoint. It was volatile, came in negative both on fixed income and equities. However, I'll show another slide that shows year to date, things look a little bit better. With the third quarter, we did see September having the worst month since March of 2020. And really, if you think back, there was a lot of things going on, both domestically from political and regulatory risks. Also from China, there was political risks and a real estate potential crisis that seemed to be averted with Evergrande. So one of the things domestically was the debt ceiling that was really on investors' minds. That extension provided a little bit of breathing room, not just in political terms, but also easing some fears in the market and concerns of a bond default for treasuries. Like Robert said, the Fed did notice or did put on notice that they would be reducing those asset purchases. They really want to get those asset purchases finished before they start to increase those interest rates. Another thing that the Fed is moving away from is talking about inflation as transitory, because it does look like it's a little more sticky. And so to Robert's point, the market and expectations of rate hikes are coming pretty quickly. Also, when we look at the third quarter, it wasn't all negative. Really, some important things happened in terms of mergers and acquisitions, and also on IPOs. So globally, mergers and acquisitions produced deals worth over $1.5 trillion, which is a 38% increase over the year, and really the highest quarter on record. Another record was on IPOs. So we had a historic 770 IPOs through the first 3 quarters of the year. The 10-year average is 205. So there is a lot of activity going on in the economy and a lot of money moving around. When we look at third quarter returns, commodities, to Robert's point, looking at oil and just those energy prices, commodities were the outperforming asset class for the third quarter. And then as you go down the line there, you'll see on the investment performance, some of the more risky areas in mid and small cap stocks were negative, and then emerging markets were negative. Again, a lot of that driven from China and some fears of contagion there. If we look at year-to-date numbers, looks a little bit different. So again, we still see commodity and energy-related sectors doing really well. Following markets, both large, mid, and small caps are having double-digit returns for the year, even in spite of having a lower third quarter return. One of the things to point out there on the right is high-quality bonds. And these are, this is going to be an important area and something that I will talk about. But so far for the year, bonds and those really conservative investors that are in bonds are seeing a negative return for the year. Now, if you think back returns for last year, those high quality bonds had a record year in terms of performance. So to our view and thought on that was a lot of those returns were pulled forward. And so kind of suffering some of that this year in terms of returns. Okay, I talked about volatility. And again, for those of you that have listened to our calls before, this is a chart that we show pretty regularly. The columns are the calendar year returns going back since 1980. And then the red dot is the maximum decline during that year from the low or from the highs. And so far this year, the S&P 500 had its first 5% decline since October of 2020. And while the benchmark, the headline benchmark decline doesn't seem as bad, when you look a little bit deeper under the surface, there was, really correction territory for those average stocks. So if you look at the NASDAQ, which is really compiled of more technology companies, down 7% at the low. Russell 2000, which represents small caps, had a more significant decline, down 11%. Now, once you look below that surface and you look at the average stock during that period, the declines were pretty more dramatic. So the S&P 500, most of those companies were down over 10%. The NASDAQ, a lot of those technology companies down about 15%, and then small caps really in bear market territory, down 28% over that third quarter. As we transition a little bit to third quarter earnings, this is a chart to look at the different sectors of the S&P 500. And what we're seeing is on the blue, that shows earnings expectations coming in above expectations. And a vast majority of these companies in each sector, from communication services through utilities, they are coming in with really strong earnings. So far, all of those companies in those sectors have announced earnings higher than analysts' expectations. When you look at that light blue, those are earnings coming in that are in line. So if for technology, about 90% of the companies beat expectations, and you can see there 11% came in line. And then the red, those are companies that are coming in with earnings below expectations. And you can see, really consumer discretionary and energy are coming in on the low end of that. When we look at earnings overall for the S&P 500, continually we're seeing actual earnings really strong. So the consensus is there shown in blue, actual is in yellow. In the second quarter, just off the charts earnings, 93% year over year. So then the question always becomes, where can we go from here? Can we continue that growth? And expectations for the third quarter were at 27%. Actual earnings so far are coming in at a 32% growth. So again, really strong. And it does show that while there are concerns about supply constraints, input costs, labor costs, can they be passed on to the consumers? Overall, companies seem to be handling this pretty well. Profit margins are looking good. The question does become, how long do these pressures last? How long can companies continue to grow those earnings? So another question that did come in and that consumers or investors have is, the market is expensive. So, we should be cautious about putting money in stocks. And when you look at the chart, historically, valuations are expensive. The S&P 500 PE ratio is coming in about 23%, or coming in about 23. Historically, that's pretty high. One of the things that, really at the moment, there's not a lot of concern on our end, with the big reason that corporate earnings remain strong and also interest rates remain low. So we don't think that we have to see a big reversal. We can grow into those earnings and get back to a little more proper valuations. Internationally, valuations are more attractive, and something that we are looking at on the investment committee about making some changes or perhaps adjustments in our portfolios for international. One of the things that I wanted to look at, and I'll just go really quickly for time purposes, but when we dissect the market a little bit, if you've been listening to a lot of commentary, you hear a lot about value versus growth. Where should we put those monies? Should we move in and out of those areas? And this is a chart that looks at value and growth from the beginning of the year. So value is in green, and really up through early summer, early summer, value outperformed growth pretty dramatically. Again, a lot of those fears of inflation, higher rates, bringing those growth stocks down a little bit. But if you were to invest from the beginning of the year in either value or growth, essentially at this point, it's been the same returns. So, one of the things that we look at is this makes it really challenging to do tactical trading and market timing. It's really difficult to get that and be consistent with that. It's not something that we look at short-term trends when we're managing portfolios for the long term. Now, on the long term, this is something that we do look at. So this is a combination of growth and value. As that line moves higher, it just indicates that growth is outperforming value. And really, over the last 5 years, growth has significantly outperformed. And this is something that we look at where it's probably time for us to make some changes in our portfolios as we look at these longer term trends. One of the things that we did earlier this fall was go a little more active management in value, and we'll continue to look at that as we revise our asset allocation here in the next month or so. Okay, so as far as the outlook goes for the rest of the year, again, the question is, we've done really well up to this point. Can we continue that trend and that trajectory? And the answer is yes, we can. When we look at historically on the S&P 500, this is an average that looks at really seasonality. And the fourth quarter is one of the best quarters historically. It's given us an average return of 4% during that fourth quarter. So yes, we can move higher from here. What I would say is we still have some headline risk with that. There is, spending and infrastructure bills coming along with potential tax increases. Also, we do have the debt ceiling that will be revisited toward the end of the year. So those are going to inject some additional volatility, but it does not mean that we have to sell off and move lower as we get to the end of the year. Okay, switching a little bit then to equity or to bonds. One of the things that we look at is fund flows, and it's interesting to see how investors have been feeling over the last few years as inflows into bonds have increased pretty dramatically, while equities have seen outflows with a recent turnaround there, but still significant assets in bonds. From a contrarian point of view, this indicates that equities are underappreciated. It also does provide for ability for investors to go from bonds into equities, so it can sustain that rally into equities. Robert did show some interest rate forecast. This is looking at the market expectations to those forecasts. So the market is really expecting some pretty aggressive rate hikes through 2022 and then into 2023, outpacing what the Fed has indicated. But it does change at 2024 at this point, where the market looks that things will level off a little bit, and the Fed appears to be a little more aggressive than that. Looking at the 2-year Treasury, it does also show that the market is pricing in rate hikes more aggressively on the front end. And then as time goes on, less aggressive rate hikes there. So another challenge for really conservative investors and those that have bonds with that inflationary background is we're seeing that real yields on bonds are really at the lowest they've been since the 1970s. And really, when you price in inflation, you're looking at 0 to even negative returns or yields when you do factor in that inflation. So it is really challenging to be a bond investor. Again, you can see that there was a lot of assets in that asset class, and that inflation is eroding some of that. So where can bond investors go? That's the question. And when we look at what the projection is for bonds, again, it really tracks what those yields look like. So as we track those Treasury yields, against the Barclays aggregate, it shows you that we expect bond returns to be pretty range bound in that 2 to 3% range. So again, the question is, why would we own bonds? And for us, and when we put it on our portfolios, bonds is a really great diversifier for portfolios. So when the market does react, when we have these big sell-offs and corrections, those bonds do hold value and they can increase in value. It also, again, provides for a source of rebalancing where we can take away from bonds that have held its value and add into equities that have been sold off. So it's still an appropriate part of a portfolio. We just have to look at it a little bit differently and be diversified in our fixed income. So overall, just to wrap up, consumers are in a really good shape, having some of the highest net worth and lowest debt servicing on record. Even with higher inflation, rates are still relatively low historically. And so, again, with bond returns, expecting a lower return area, but it's still a good diversifier in portfolios. And then lastly, with that inflation backdrop, equities have historically been a really good hedge against those inflation pressures. So with that, I will turn it back to Tabby and go into a little bit of Q&A if we have some time.
We only have a few minutes, so we're going to quickly go over a couple of questions, but I want everyone to know if you go into the chat right now, I actually copied our emails. So if you have follow-up questions that we didn't get to, we do want to talk to you. So the first question is going to be to Robert. In maybe a minute, can you summarize what is the future of the labor market? Are we headed towards a reset?
That it's interesting. I think we're in the middle of a reset. Now that we're 18 months into this, there is a major shift going on between workers and employers. And we're seeing that in a number of different ways. We're seeing it in where people want to work, the nature of what they want to work. When we look at that quit rate, it's up so much, and that big change in the labor participation. These are all examples of people kind of revisiting what they want to be doing and how they want to be working and how and where they want to be working, and we don't know where this is all going to end up. Many employers have been saying, okay, we're ready to come back again, and then they push it off. And so there will be, we will continue to see these changes, and we will continue to see this reset going on. We just don't know exactly how much it's going to change. Will we go back to where it was before? I don't think so. We just don't know how different things will look 5 years from now at this point.
Yeah, I think that's fair. It's just everything continues to evolve, and I'm constantly surprised by what is being affected in the market and at the grocery store. So I appreciate that. Okay, final question for Rich, maybe even just as a bit of a summary, given what's been discussed, what are your final remarks? What would you tell clients that are looking to invest?
Yeah, what I would tell clients, the big question that always comes up is markets are at all-time highs where we are again now. So I'm nervous to put new money to work. And I think that's a big reason why you see a lot of those funds go into bonds, those investments. But again, bonds are challenging. In terms of inflation, you're kind of losing money safely by having it in bonds. So for investors, again, it really comes back to being diversified, having a good asset allocation in your account, and then also working with your team. We have a great planning department that is really laser focused on any of the tax changes. So making sure that everything is coordinated is really the best approach as far as new investors or even existing portfolios.
Great, thank you. Thank you to both of you. And just so that everybody knows, these are both fantastic resources. You can reach out to Rich and Robert at any time with questions and concerns that you have, and we can always direct you if you have other banking questions. So thank you for joining us. Thank you for your business. Thank you for continuing to trust Zions Bank with your banking needs. We'll continue to host seminars like this one, and we hope you continue to join us. I hope you have a safe and eventful Halloween weekend. Thank you, everyone.